We can see real estate fall 20% from here and still be higher than they were at the end of 2019 before COVID. You may say, oh man, 20%, that's crazy. That's nuts. It's not that nuts when you're seeing, especially rentals, and that market double-digit growth last 2 years, which is insane of how much rentals have gone up. And you say 20, 30% is crazy. The publicly traded REITs, Camden Property Trust, Mid-America Apartment Communities, Essex, these are names I've researched. I've researched for my newsletters several times over the year, very familiar with these. They're all down 30% year to date. And when you look at these properties, which I've done the homework here, to compare, Camden has huge operations in the South and the West. That's where most of their properties are. Essex, huge operations in Western U.S. Mid-America Apartment Communities. You think Mid-America, it's big operations in the Southeast and Southwest regions. These are the same regions, demographics, and Blackstone's REIT fund, which is private. And at the end of September, they said it's up 9% year to date. Well, everything else, those other three are down 30% plus. But again, I know these regions are similar to where they own their properties because that's, when I was researching them, all the places I want to be in. You're looking at Florida, you're looking at Texas. No state income states. Holding up much better than other places. So if you're going to move from places like California, New York, where you're giving away 60% of your salary, like F this, I'm going to go to Florida, Texas, Nevada. What is it, 6 of them, I think, altogether? I mean, you save a lot of money. There's the reason why DeGrom signed and left New York for Texas. And if you do the math, it's probably about whatever his contract was. I think I was looking at it. It's probably $18 to $20 million he gets an extra just because of the state he decided to move to. It's a big difference when you're talking about this type of money. So in terms of taxes. Not to mention that's where the population growth is, right? So that's what you want. That holds up the value of these apartments and these real estate investments much better when you're looking at the demographics of these areas. So they're all kind of in the same areas. That's where the growth is. But you should see how many properties Blackstone purchased over the past 2 years. The top of the market. It's insane. Again, I dig through this, probably about 5 or 6 extra clicks to get in, but you will see it. They have 20 pages of all the investments that they made. And yes, they're going to say occupancy above 90%, 90%, 90%, whatever. Let's see how that goes going forward and the prices. But according to the fund's data, okay, coming straight from their website, 78% of this fund is in rental housing and industrial. It says the fund invests in rental properties where rental growth exceeds inflation. Think about that. I don't want to get too complicated here. Rental growth exceeds inflation. Inflation was very, very high, but rental growth was double digits. Inflation never got to the double digits. That was great. But now, this is their fund's objective. This is what they're supposed to do. Let me ask you a question. Is there an area today that you can find in the U.S. where real estate or rentals is outpacing the pace of inflation? I mean, good luck with that, especially trying to buy properties like this going forward with economists expecting inflation to stay above 3% by the end of 2024, maybe into 2025. Will rentals grow? Because they're going down right now. Three months in a row, we saw rental properties have gone down. Yes, off of a very high base, but they're going down. And remember, what's the alternative here? And this is a safe investment. I'm going to invest in real estate. I'm going to invest in Blackstone. I'm going to invest in Starwood. Safe investments. This was a great investment pre-January. Now you can get 4% risk-free without worrying about selling real estate where prices are starting to come down every single month. Also within the fund, it says it has a 2-year weighted lease length across its rental portfolio. So every 2 years it resets. It gets 70% of its assets. So how much do you think that they're going to be able to charge for rent once this 2-year period is up? As it resets after 2 years. Maybe it's 20% of their portfolio resets over the next 3 months, another 20%, whatever, over that 2-year period. You think you're going to be able to get more? Maybe over the last 2 years, maybe a little bit more, but think about that as we keep going forward. It's pretty crazy. The fund states that 87% of this is fixed rate financing. That's cool, but again, The average lease is 2 years. You're buying more property. So you're buying the property and renting it out, but buying the property going forward, which is this fund's injected. Are you going to be buying any property? Probably not. You're looking to sell it. And buying it, where were we in January? 3% in mortgage rates. Now they're well over 6%. Also, when you dig into the company and look at its disclaimers, which is always fun to do after something blows up or there's trouble. No one ever does it. Everybody just wants to invest. They don't look at disclaimers. They don't care. But when shit blows up, FTX saying, "Oh, we have no responsibility," no, all these disclaimers that you think are all bullshit. This is why when you look at prospectuses and stuff, they're like, 87 pages where 65 are all these risks. If I walk outside and lightning strikes a building and the building collapses on the car blows up and I burn to death, I'm not going to have to pay anybody. They'll throw any single risk possible in there, anything possible, even it can't happen. That's what they do. So when you look at some of the disclaimers, it's kind of funny. It says Breed has incurred $702 million in net losses, excluding net losses attributed to non-controlling interests and third-party JV interests for the 6 months ended June 30th, 2022. So this fund was losing a shit ton of money in the first 6 months of 2022. What do you think has happened over the past 5 months? You think the real estate market is better the last 5 months or worse? You think it's going to get worse into next year? It's completely shut off. They say this amount largely reflects the expense of real estate depreciation and amortization in accordance with GAAP accounting rules. Wouldn't you expect that to continue going forward? You think these losses are going to increase? Does anyone own a real estate property in the U.S. that's worth more right now than it was 6 months ago? Maybe a few of you, but most of you know. And I talk to people who are trying to sell some of their high-end real estate, and it's on the market for a few months, and they can't sell it. And this is in Florida, which is one of the prime markets. Getting back to redemptions, UBS says that a ton of redemptions is coming from Asia. Do you guys see what's going on in Asia right now? I mean, it's so funny how people are looking at it going, "Oh, Asia's fine." 1 week. It's fine. It was terrible, these protests, and now it's fine. I've been there. Do you know when these people leave Foxconn, they go back to mid-China? They go back to where they live, right? They go here 6 months. They have these facilities that I visited, that I saw in Shenzhen, and then they don't come back right away. Oh, government said everything's okay. No. Are you kidding me? I mean, there's some great YouTube channels that you could follow that are being suppressed. Everything's being suppressed. They don't want anything, any censorship at all to show what's going on. Asia, especially China, is terrible right now. Real estate is down incredibly, especially commercial real estate. And there's quotes from some of the people running the biggest real estate companies saying this is a tsunami. This has never happened before. We've never seen this. Profits down 70, 80%. We've never seen anything like this. So what are they seeing here? They're like, "Oh, we're invested in real estate, but we need money to either cover some of those expenses." So they're looking to sell right now. Not to mention, it makes sense to sell some of these private REITs because they're up tremendously. I mean, we want to sell them for tax purposes, but you know that the market, once it readjusts, I mean, everything else is down 30% within the same category. The only reason this is not down is because it's private and they're controlling the liquidity around it. But then even with Asia, you can say, okay, I'm just going to buy, 2-year treasuries, earn 4% risk-free. I don't have to worry about selling this hard asset, which is illiquid and hard to sell, even if it's not private. Or maybe you're like, listen, Asia's down so much, I'd rather spend money there and have a 10-year outlook buying that real estate that's down tremendously more than it is in the U.S. right now. Either way, they're asking for their money back. So even foreign investors invested in these things are asking for their money back, especially through the UK, especially through Europe. Also in Blackstone's disclaimer, which is cool, it says, there is no public trading market for our common stock, and repurchase of shares by us will likely be the only way to dispose of your shares. Again, everybody pays attention to this when it's too late. And they say, we're not obligated to repurchase any shares under our share repurchase plan and may choose to repurchase only some or even none of the shares that have been requested to be repurchased. In addition, repurchase will be subject to available liquidity and other significant restrictions. Again, there's no liquidity. Further, our board of directors may make exceptions to modify or suspend our share repurchase plan. As a result, our shares should be considered as having only limited liquidity and at times may be illiquid. Sounds like this is one of those times. So in other words, there's a disclaimer. If you're invested in this fund, you're basically fucked. Outside of the 2% redemptions you're allowed of total asset management every month, you're not getting your money back. But this ends up to be a lot of money. If you're looking at 2%, it constantly drags more and more and more, which is going to mean I'm going to have to sell more properties, which they've done. More of their good properties. And this is just, I'm just talking about Blackstone. Look at the whole industry. But as investors, I guess it pays to read the fine print. Sometimes. It's not easy. Disclaimers everywhere. So what does this all mean? If you look at real estate prices, they're likely, very likely, very, very likely to collapse in 2023 and probably into 2024. Since there's no demand to buy these homes where money already dedicated to be invested in real estate is locked up and they're trying to get it out.